you've got a tiny percentage of the overall market cap of crypto and Bitcoin specifically. It's about 2% of the market cap of crypto in leveraged futures, and yet they're somewhere like 70% of trading volume with a lot of leverage, right? And so this tiny portion of the market can have a really disproportionate effect on price moves and volatility. That's what we saw in that October 10th flash crash. Obviously, major corrections across the board. Some cases, 50% intraday corrections in smaller crypto assets. Even Bitcoin was down 14% at one point on the day. And so that definitely has a bit of a chilling effect for at least a couple weeks after something like that happens. And I think that's kind of the overhang that we're seeing.
Now, the pitch of Bitcoin ETFs is diversification without the friction of a crypto exchange or wallet setup. But is it really functioning as a digital gold replacement or something else entirely, especially since gold was hitting record highs while Bitcoin sold off?
Yeah, well, gold, of course, has come back a fair bit too in the last week or so after that record high. And what we see oftentimes is that when you zoom out, they tend to move in sort of medium long-term cycles together because they have a lot of the same drivers. And then within an even short-term period, sometimes one is rallying and the other is sort of flat, and vice versa. So that's kind of what we've seen here. But it goes back to, there's kind of two levels in this market. There's a top layer, which is very sort of short-term, speculative, often trading with leverage, that does treat this as sort of a levered NASDAQ almost asset, even though that doesn't make much fundamental sense. And that creates the volatility. And then you have this much larger lower layer, which is more sort of long-term institutional buy and hold, wealth advisory type investors. And they tend to ultimately accumulate on those dips in the aftermath of some of these, volatility driven sell-offs.